Is it for everyone? I think I enjoyed the first 3 seminars because they all had to do with Excel.
Yeah.
Very useful. I don't think I will ever use Microsoft. I never used it. In fact, I never heard. I just heard about it, but I had no idea what Microsoft does.
Okay, let's get started, please. Okay, so I want to continue on with the stock selection. Are there any questions before we start? Okay, webcast students, I did send you one PDF file, and there might be another PDF file I'll send at the break. Okay, so basically what we did on Monday was to go through this kind of regression methodology for selecting securities and trying to contrast it with a simple screening methodology that involved some sorting. What I want to do today is to continue with that, show you some additional results on the sorting methodology and figure out a way to actually put all this information together. The thing that I wanted you to think about over the past couple of days was, given that you've got all of these sorts, how do you put it all together in terms of an optimal portfolio selection or optimal stock selection strategy? Okay, so I guess what I'd like to do is, just so everybody is on the same page, just kind of review what we're doing in terms of sorting. Okay, so basically, sorting. So we pre-specify some attributes that are firm specific. And number 2, organize data. Actually, I put number 2, you might think that that's not a big deal until you actually try to do this job. And it's a huge deal. To try to merge all of the databases that you'd be using. So the exercise that I did had a combination of MSCI, IFC, IBIS, CompuStat, WorldScope, and a couple of others, depending upon the country that we're looking at. All this data has to be merged. It has to be done in a way such that there's no look-ahead bias, there's no survivorship bias, and when you look at the book-to-market ratio, December 31st, and form a portfolio that'll be held for January, you have to make sure that that book-to-market ratio is available December 31st. Okay, so that's really important. The data must be known because this is a conditional selection. So organize data, which is basically meaning merge carefully. And organized data also means to check for data errors. And just running simple filters on the data, you're going to see some crazy numbers. And you need to basically resolve those problems. When we're talking about, one of the markets that we looked at last time is not that many securities. But when you go to larger markets, I'm going to show you at least a few results for the US, where I did a screen yesterday with like 6,000 securities. There's a lot more data to check over when you're doing 6,000 versus 300. Okay, so check for errors. And then what I recommend methodology-wise is to run univariate screens. Okay, and we looked at some of those. I guess the one that we looked at in detail last time was the dividend yield. So it could be dividend yield, could be price to book, it could be prospective earnings. Divided by price. Okay, so run univariate screens. It's number 3. Number 4, evaluate. Okay, and here we're going to look at a number of key criteria. So the first one is it's listed A, just the return. So the average return. And last time I had like 27 different diagnostics. Let me just tell you the ones that I look at that I consider the most relevant. So the average return is obviously important. And really what we're talking here is kind of like the spread. So high minus low. That's number 1. Number 2, I look for consistency across the fractals. Okay, so what do I mean by that? Let's say I've got 3 fractals that have sorted all the securities into 3 fractals. So one is high attribute, one is middle attribute, one is low attribute. And I look at the spread, and the spread looks okay. So high attribute's got a higher average return than low attribute. But when I look at it, it turns out that middle attribute has got the highest return. Okay, so you get a pattern where it's not consistent. What you'd like to see, if this attribute really has some explanatory power, is for high attribute to have the highest return, middle in the middle, and lowest the lowest. Okay, so in terms of returns, you'd like to see if this is high, middle, and low, kind of like to see the returns look like this. So consistency. That's B. C is consistency across time. Okay, and actually, if you looked at those scoring sheets, you would see it would kind of like rank the fractals every year. And what you'd like to see, if this attribute really has the ability to explain the returns, is for the high fractal to outperform most of the years. It won't outperform like every single year, but it should outperform most of the years. Okay? So that's consistency. So high fractile, so H, let's just call it H, outperforming most of the years. Okay? That's point 1. Point 2 is H doing well at end of sample. So for example, I could forgive this attribute if it did kind of like not that great early in the sample, like 87, 88, 89, but then all of a sudden it's been very consistent over the last 5 years. Okay, so I kind of weigh the most recent data higher than the past data. Okay? H not falling into loser category. So as soon as it, if I see that it's kind of, this is closely related to point number 1 here, outperforming most years. Like I put a negative weight if all of a sudden it is like the real loser. Okay? And very much related to this is H having a really bad year. Okay, so even if it performs well on average, if it's got this possibility of having a really bad year, then I'm gonna think twice about it. Okay. So that's C part. D part. What else do I look at?
Yeah.
Yes.
Back on time. How do you know how far back to go without, in essence, data snooping by saying, well, 7 years isn't too far? It starts skewing your results.
Yeah. Well, a lot of it has to do with your data availability. So, for example, a lot of these screens will benefit from expectational data, like IBIS kind of data. You know, it doesn't matter if it's IBIS or first call or Zax or whoever. That expectational data is really important, yet that data doesn't go far back in time. So a lot of it's data driven. And you know, for the US screens that I'm usually doing, I usually sample from 1988. So I had a screen running before class that combined some IBIS data with some fundamental data. And it kind of started out, when it started the screen, it was operating with 1,000 securities. And then by the time that we got to 1995, it was about 2,500 securities. So the number of securities is going to change. And a lot of it is just data availability. What I usually do is hold out at least 3 years for an out-of-sample evaluation. And that's the practice that I followed in this research. So hold out 3 years, look at the screens, kind of put them all together, develop this scoring screen, which we haven't actually got to yet, and then run that scoring screen out of sample for about 3 years. See how it does. Yes?
I have a question regarding the last point that you said it's expectation of age having a really bad year. And this sounds, it's kind of a subjective assessment that might, you know, conflict with your quantitative assessment. And I'm not sure how, since you're predicting into the future, how much weight do you give it, your subjective expectation of age?
Right, yeah, okay, well, I guess you're noticing that this is a combination of quantitative stock selection with some subjective judgment. Okay, and indeed, what we're trying to do is, you can think of this as modeling complex nonlinearities subjectively. Okay, so if I look at this, and if I just ran a regression, or if I just ran the screen, and I saw that, well, we saw Malaysia provided a 25% spread. So market neutral portfolio with 0 beta against Malaysia. okay, delivered 25% return on average. Okay, that's pretty good. 2,500 basis points for no market risk. Okay, now when I look at the data, it turned out that that screen was pretty consistent. But what if I looked at that data pretty carefully and found that in 1998, let's say, that the actual spread was like minus 50. Okay, so the regression, is just going to average that in. So it must mean that there was like a plus 50 somewhere in the data also. And it's just risk. It's a subjective evaluation of risk. That if I see that there is a possibility that when I implement this strategy, looks good, 2,500 basis points, that looks great. But if I see there's a possibility of a year where I'm going to take a minus 5,000 basis point hit, then I'm worried about this attribute. The regression's not going to get that because the regression is working on averages. We pooled all the data together, we would just get that we should just pursue the dividend yield strategy. And you're not going to see that in the regression. Maybe you're going to see the t statistic is a little lower. It's still going to be significant, but you're just not going to see it. And especially if it's a multivariate regression with many factors, you're not going to see that the dividend yield is getting you into trouble in 1998. Does everybody see that? That's an important insight. You're running a regression, it's got 3 factors in it. It delivers predicted values each month. You sort those predicted values, you buy the highest expected return, you sell the lowest expected return, you just kind of continue doing that. Okay. You have no idea that maybe in one of those years, one of those factors is leading you to potentially a disastrous performance. Whereas what we're doing here, factor by factor, we can actually see that and then provide some subjective weight to potentially get rid of that factor. So there is a scenario, a very real scenario, where the best factor based upon your univariate screen you may choose not to use. And that can happen many different ways. So it might provide a very good spread in returns on average. Okay, but remember, that's the historical average, and it assumes that we can hold this for a long time. Our evaluation period, in terms of us being evaluated, is like 1 or 2 years. We don't have 12 years of data to work with. Okay, so our best screening factor could be discarded if it provides a lot of volatility in performance, it's not consistent, things like that. Okay? So again, this goes beyond the regression methodology. Regression, you just can't see this factor by factor. Okay? If you ran the regression just with dividend yield and did diagnostics on that, maybe you can see some of these issues. But as soon as you put it all together, it's extremely difficult to extract the information. Okay? So what you can think of us doing is, in a way, building a regression model without using least squares. Okay? What we're doing, we're operating on all of the components using subjective judgment along with quantitative assessment in trying to put together the best possible model. Okay, so D, what else is important? One thing that you notice that I do is I look at performance across size. Okay, so I'll do a bivariate sort of the factor performance, then look at size. Or look at size and look at the factor performance. So what I'm looking for here is robust performance of the factor across different size categories. Okay? And sometimes you see that the factor works really well for a particular size category, but not for another. So for example, it might work incredibly well for smaller capitalization firms, but not that well for larger capitalization firms. And that's incredibly valuable information, because some of these factors, it kind of makes sense that if you really think about what we're doing is kind of like combining information, okay, in the best possible way. And it's often the case that the smaller capitalization firms, they're slower to get the information impounded in price. Okay, so these are the securities that we've got the best shot at in terms of making a large profit on selection. And they don't have to be teeny securities, but just like smaller than the largest securities, the ones that are the most followed. Now, what I don't like is a strategy, which is offered by a number of mutual funds and investment managers, just to buy small cap. Small cap on average has outperformed, let's say. But what I'd much prefer to do is to ask the question, well, why do they outperform? And I can tell a story that maybe it's the case that it takes a little longer to get, let's say, earnings expectational information impounded in these prices, because these are smaller cap securities, not as many people are following them. Okay? So there, I can sort by size, take a look at the smaller cap securities, and figure out, based upon the attributes, which ones are most likely to outperform. Okay, now that is powerful. Just to buy small cap, to me, you're going to be buying a lot of losers, which you could avoid. Buy the ones with the best prospects. Okay, so none of the strategies are size-based strategies in my research on stock selection, because it doesn't have enough economic content for me. Okay, and it's true that maybe it's been profitable historically, but we're looking forward. Okay, what I want is take a look at size and then look at these attributes to see how the attribute performs across different size categories. Okay, so look at performance across size, and basically, let me just say economic story for size. Okay, so one thing that you don't want is some spurious association of the factor with size. So you can avoid that. Or letter E, risk. I put it last, not because it's not important, but what I find when you do these screens, that the risk of the high fractile portfolio and the low fractile portfolio are often very similar. So this turns out not to be that big of a deal. But you do want to look at it. Okay, so if the betas are different, then you need to make adjustments. Okay, but it's often the case that the betas are different the wrong way. So the high performance fractile has got a lower beta than the low performance fractile. Okay, but nevertheless, we need to actually look at that. So these are kind of the 5 main things that I look at when I evaluate these, pretty comprehensive sheets. Okay. So what I'd like to do is kind of go through some of the results and then kind of put them together. So just so everybody's on the same track, as I said, I want to emphasize exactly what we're doing.
Cam?
Yes?
Quick question.
Sure.
If the signs of the betas for the fractiles were in opposite directions, would that change your strategy of buying one and shorting the other?
The signs of the betas?
Right.
Okay,
Correct.
I've never done a screen where I've got a beta that's negative. Okay, as a matter of fact, I can't recollect a screen with a beta less than 0.8. Remember, these are large, diversified portfolios. It's extremely unlikely that the portfolio's got a negative beta. Indeed, it's incredibly difficult to find any security with a negative beta. To find a portfolio, that'd be different. So, would it impact what you do? Yeah, depending on which one is negative, right? So, if the good performer has a negative beta, that's just going to pump up your alpha dramatically, right? So you want to look at that. Okay, so let's talk about implementation. Okay, and I'll go through a simple way to do this, and then we'll go to the mean variance way, and I want to show you lots of results today. So implementation, let's say we go through, we've got 27 factors that we're looking at. Okay. We run the screens, and let's say everything is in trittiles. So we've got 3 fractiles, high, medium, low. Okay, we look at the performance, we look at the spreads, we look at everything relative to the benchmark in that market, and make some assessment. And suppose that we find that we've got, I'm just going to make this up, but suppose that we find that we've got 4 things that look important. Okay, so there's 4 screens contain information that we're satisfied with. Okay? So, and let me be a little more specific here. The screens are, suppose they're the change in FY1. That's an IBIS screen. And the high portfolio does really well here. And then we also have a simple 1-year momentum. High portfolio does really well there. Okay. And let's say we also have price to book. High portfolio does okay there. And number 4, you actually find that something like the change in ROE, this has the ability not to do really well. It does kind of average for the high portfolio. But the low portfolio has got the amazing ability to underperform. Okay, so this one is picking out losers. So this one is actually picking the loser. So everybody sees how we're doing this. Every month we are sorting all the securities in the universe, forming a portfolio, holding it for 1 month. At the end of that month, resort, reassign to the portfolios. Okay, so we've got this information, and we look at these relative to the benchmark. Okay, so let's say we look at the returns, and let's say these are returns minus the benchmark. And for FY1, we get 20%, we get 10% for momentum. Price to book, we get, let's say, 5%. And then when we look at the ROE, it delivers a minus 20%. Okay. Now we need to put this information together somehow. Now, as was mentioned, I guess we talked about this on Monday, it's possible that the same stock is in every single one of these portfolios at some point in time. Remember, through time, these portfolios are changing. Every month they're changing because we're sorting every single month. Okay, but if we look at a particular month, a particular stock, it is possible falls into all 4 of these portfolios. Okay? And it's possible a stock doesn't fit into any of these portfolios. So we need a way to kind of put this information together. The simplest way to do this is to assign some subjective score. Okay, when we look at this, it looks like the change in FY1 is the best screening factor. And let's just specify some sort of scoring based on a scale of -3 to +3. So I'm going to assign a 3, a 2, a 1, and a -3. Okay. So what does that mean? Okay, well, start this off. We've got a sort. Let's say we're beginning to run this live. Okay, so we're sorting the end of January 2001. We do these 4 sorts. Okay, we've got 4 portfolios, right? And let's say each one of our portfolios has got 1,000 securities in it. Okay? 4 portfolios, each one's got 1,000. There's overlap, and maybe the whole universe is like 3,000 securities. Every security that ends up in the FY1 portfolio, January 31st, 2001, I give a score of 3. Okay? Every security in the momentum portfolio, I give a score of 2. Every security in the price to book portfolio, I give 1. And the change in the ROE, I give a -3. Okay? Then what I want you to do is to think of the following. Given that I've done the scoring, think of a spreadsheet. And the spreadsheet's got one column is the firm name. And then I've got columns for FY1, momentum, price to book, ROE. Okay, and this is for January 31st. So all of this is January 31st, 2001. Okay? I go firm by firm and tally the scores. So firm 1, maybe it's got, it shows up in this portfolio, doesn't show up in momentum, doesn't show up in price to book, doesn't show up in ROE. Firm 2, maybe it shows up in the first 3, but doesn't show up in the ROE. Firm 3, it shows up in FY1, but it also shows up in ROE. And you can see basically what I'm doing here. Okay, so every single security, every security's got the possibility of collecting 4 scores. Firm 5, there might be nothing. Okay, so it just doesn't fall into any of these sorts. Now, hopefully you can guess what's going to happen next, right? Sum. So 3, this one is 6, this one is 0, this one is 3, and this one is 0. Okay? Sum up the scores for each firm, and then what do I do? Sort. Sort again, and basically I've got the whole universe of all my 3,000 securities. I can implement this with the top scoring, 1,000 of them if I wanted to have a portfolio that big, or 500, whatever. Questions? Yeah.
Would you think of, say, firm 3 and firm 5 any differently? Because even though they both have a score of 0, 1 didn't register.
Yeah, I think I do think of them differently because they're given kind of conflicting information. It turns out that both of them, and really, if I added to this realistically, firm 6, there might be like a -3. So I'd have some minuses there. It's likely the case that these firms would be in the middle portfolio. The ones with inconsistent ratings are often going to be in the middle portfolio. Okay, yeah, this is just a simple metric, right, where you add the stuff up, right? Could you think of a way to kind of adjust for what you're suggesting could be an issue? I'm asking the question. So basically what you're saying is that, well, this firm that has got a 0, that's different than having a 3 and a -3, where you're in the deep loser category here and the deep winner category here. So is there a way to somehow incorporate that kind of information? Yes?
Well, you could give extra weight, or you could add on, I don't know, fraction or a point for multiple. If like an if-then statement, just simply if you've got more scores, the sum of your scores may be telling you that this is a more robust, this firm's giving you more robust information, and therefore it might get extra weight.
Exactly. So you could have some ad hoc rule that differentiates this firm. Or what I was actually thinking of is you could even think of the standard deviation of these scores as a factor, right? Because often you got more of these negatives in here, and this has got a big standard deviation. It's from 3 to -3, whereas this one here, firm number 2, has got a fairly low standard deviation, right? So the standard deviation tells you something about the consistency of the signal that you're getting. That could be another kind of add-in to the scoring screen. Yes?
You're breaking your initial sorts down by thirds, correct? For each of these factors? Well, I'm sorry, I can't remember what you said.
Yeah, so for each one, okay, for each of these sorts, I've got 3,000 securities, and I'm creating 3 portfolios with 1,000 in it. There's no second level of sorting here. So I'm not sorting by change in FY1, and then sorting again by momentum, and then sorting again by price to book. Okay, so that's not what I'm doing.
But with only one negative factor or attribute, is it gonna dominate the cell portfolio you come up with? Because in this case, basically, you can see a situation where you might not get your strongest factor in the buy portfolio because you might have another, you might have the price to book and the momentum going your way. But it seems like the ROE is the only negative factor is going to really dominate. It's basically going to be that depending where you make a cut.
You look at the data, and ROE could be the only thing that's consistently identifying losers. So you go with the information you can extract. There's a lot of firms that are going to get zeros off of the other factors, and those are candidates for underperformers. But yeah, if you had some other factor that looked okay, like in my hypothetical example, it's simply ROE, but there might be more. But you have to go with the consistent information. And again, I've looked at, think of this, there's 27 factors, so 54 different high-low portfolios, right? And I've gone through, I've done my consistency check, I've done all this stuff, and I'm comfortable that these 4 factors are yielding information. And just go with that. Yes, Brian?
What if you have a lot more positive factors than negative factors? This is similar to what Chris asked. And then when you cut up that sort into the fractiles, your bottom fractile happens to have, just because of the preponderance of positive numbers, some firms that have positive sum totals.
Absolutely.
Do you still short those firms that have positive totals in the bottom fractile?
Yes. Because you want to create a market neutral strategy. You only care about the spread, right? So it could be that your bottom fractile performs that benchmark, right? But your top fractile does really well. And you've basically just taken the market out. So, it is possible after you look at the data, right, that you see, well, the short portfolio, it just doesn't do that well. Like in terms of underperforming, that it looks about market, then you might want to reassess. Maybe what you want to do is to buy the high portfolio and then do something else to take out the market. Like if there was some sort of index that you could use to do that. So maybe you would reassess. But it's the spread that counts. Yes?
If we had a situation with like a firm number 7 that has 3, 2, 1, minus 3.
Spread it in.
So it has a score of 3.
3, 2, 1, minus 3.
Yeah.
Got it. So it's got a score of 3.
3. And this is like firm 1. But it has this, it's also, the situation is different because you know that this firm is sort of a loser, it's supposed to be. Would you assess them differently, or is this already embedded in the way you choose the scoring?
Yeah, no, it's an excellent point. I would put that in the category of, the other question. This is pretty volatile. Like this stock ends up in the winner portfolio and the loser portfolio, right? So on average, the score is 3, but that to me is a lot different than firm 1 that's just got. It ends up in the best portfolio, basically, right? And that's it. It doesn't end up in any of the others. So this one's got low volatility. This one's got high volatility, and that might actually make you, go with this stock. If it was a situation where we're kind of like trading them up. So note that it's possible this 3 could end us in the middle portfolio. Right? So then we don't have to worry about it.
But if it does end up in the high portfolio, you would pull it out.
I might put it out, yes.
Firm 1, I guess, we're asking.
Yeah, firm 1 I would, if there was a tie, I might prefer firm 1 to firm 7. Okay? Actually, in this case, I might actually do a little investigation as to what this ROE actually, if there was any extraordinary circumstances that put the ROE there. Okay, and that is possible. Okay, yes.
Well, I understand the intuition about the standard deviation, and that basically that sort of this I understand how this you sort of can call this volatile in a way. Couldn't you also say? I mean, I'd actually probably prefer firm 7 to firm 1, simply because I know more about. I feel like I know more about firm 7, and also if I've made a mistake on a factor, at least I've got a lot more information to sort of go on. I mean, that's kind of, I guess, what you're talking about with the ROE. There may be something extraordinary about this ROE. But wouldn't there be an argument to be made that maybe you want to go for the factors you know more about, or the attributes you know more about?
Again, in a tie situation, right? Suppose that, and this is, we call this quantitative selection. We're using a lot of judgment. And there's other stuff that goes on beyond this, right? Because you get your list. I've already told you that people sit down with the list and ask these hard questions. Because you're going to get some ties. What do you do with the ties? What if I told you that I looked at firm 1, and it turned out that from momentum, it was just outside the high. It was like at the upper part of the middle. And same story of price to book. And ROE, it was kind of close to being in the loser portfolio, but it wasn't quite there. So you kind of like go beyond the information you've got. You've got where this firm actually placed, right, for all of these factors. And you actually use that information. Okay, so there's other stuff that you could, so it's not like there's no information on firm one for momentum, price to book, and ROE. There is information. You know what portfolio it ended up in. And maybe it ended up in the neutral portfolio, but for this one it really stuck out as something. And remember, FY1 is our best factor in my example. Yes?
Question on sort of the scoring numbers themselves, the 3s, the 2s, the 1, and the -3. How subjective is it? How much mathematics are you using it to
Right now it is purely subjective because we haven't done anything optimal. Okay, so you could create your own scale.
Later
Okay,
you'll
so
optimize sort of, or
right.
discuss how you optimize it.
Yeah, no, we're going to discuss how we actually take this and optimize. Okay. But again, we call it optimization. This is highly quantitative, but nevertheless, even with the optimization, there's going to be a lot of subjectivity. Okay. That, one of the key mistakes that people make in quantitative, modeling is they sometimes just listen to the model. And there's a lot of art in putting these models together and implementing them. It's easy for me to write down some equations, but to actually implement this stuff is very difficult. Yes?
Just following up on Jonathan's question, would it make sense to impose just a little bit of structure? Because like in this particular case, you have FY1 coming in at 20% and say price to book coming in at 5%. So really, FY1 is giving you 4 times the contribution in your portfolio.
Sure, and we discussed actually some different weighting schemes after the lecture on Monday, and one weighting scheme would have the weights exactly proportional to the performance. So in that case, we could think of actually, instead of using 3, use 20. So go for firm 2, it'll be 20, 10, 5. And firm 3, minus 20. You could do that too. So that's some more structure, but this is subjective at this point. Okay? It's subjective. I'll tell you it's subjective, but it's not all that bad. To have very coarse categories and to take a look at this and assign some scores. And indeed, this is probably the way that this stuff is most often implemented. Okay, so you get that what we're doing here is probably really close to the way that this stuff is actually done. Yes?
Just a quick question. Does it matter when you're doing your thirds for like FY1, you're saying that portfolio outperforms the benchmark by 20%, but you might have 1,000 firms in there.
Correct.
Who are averaging at 20%
over time.
Outperformance over time. But does it make any sense to maybe break that down either into smaller fractiles or to look within? Because that means you could have some who were like 40, 50% outperforming over time. You're sort of, what I guess I'm arguing is you're lumping all these guys in together, giving them a factor of 3 when an individual firm may have contributed more or less.
Remember, the firms are coming in and out every month. Right? So I guess what you could do is to look at one firm and trace their history in that fractile. But it's likely the firm goes in and out. Right? So when I say there's 1,000 firms, there's 1,000 firms in this January 31st. Maybe what you're saying is if we looked January performance, that there's going to be some firms that did 60% return. Okay, and some firms less. On average, we get 20. Right? And do you want to go within the fractile and start to assign differential weights within the fractile? That's really what you're asking.
Yeah. Break the fractiles down, be quintiles, deciles.
Okay. Yeah.
And then not even use the most extreme, but say the second quintile high portfolio is still outperforming.
Sure.
Assign that like a lower weight than the first. Just wherever you feel like there's meaningful.
Yeah, no, it's a good point, and indeed, we haven't really discussed what the optimal slicing of the data is. So my example is just for simplicity, so I can go HML. That's the only reason I'm choosing a tritile. So for a market with 3,000 securities, you would not look at tritiles. You look at deciles. Okay, but a market with fewer securities, you might go to tritile. So it's got to have enough in it that it's a diversified portfolio, and that's it. Now, once you start going within, so let's say we had 300 in our fractile, you start going within, then it could be a little dangerous in the following sense. That the whole idea of doing the sorting stuff is to kind of coarsen information. Let me be more clear as to what I mean. So we're not looking at the individual returns. We're just assigning a rank. And this stock is either 1, 2, or 3. That's it. So it doesn't matter if it's 60% or 30% or 20%, it's getting a rank of 1. And we're going to work with that. So anytime you do this sort of thing, it's kind of like coarsening the information. So for these two securities, they look the same because they both have, they both fall into the H portfolio for FY1 change. Okay, so in a way, you're throwing some information away that's related to their actual performance. So that's what this sorting kind of stuff does. And that's why I said that there's a way to view sorting in the context of what's known as a multinomial probit. Okay, probit and logit, some of you know what that is, where it's a regression. A logit is a regression on a 1 and a 0. So your dependent variable is a 1 or a 0. Okay. And a multinomial logit or probit is a regression on ranks. So what you're trying to predict is the rank. Okay. And effectively, this is what we're trying to do in this sorter. All of this can be cast in a regression-like framework in terms of a multinomial probit. And I've done some experimentation with that. It turns out it's not that easy to estimate. This is easy to actually work with. Okay? Now, there were, yes?
Yeah, once you verify the data using this regression, and you get it 0 R-squared, but you invalidate the screening and sorting.
Oh, we're going to validate, absolutely. Yeah, so we have to, this is for 1 month, January 31st. We're going to sort by the sum and create a buy portfolio and a sell portfolio. And we're going to hold that for February 2001. And we'll likely go back in time to back test our model. And then we want to look at the performance of that model. Okay, so can we validate this with a regression? Yes. Okay, is it going to be a regression on these 4 attributes? No. Okay, so, but there are ways to validate. Okay, yes?
I have a question on the scoring. You were mentioning about the comparing firm 1 and 6, and then saying maybe firm 1 is close to the lowest performing ROE, so close to getting -3. And couldn't you capture this by basically, you say, for example, if it's high, you give it a 3 on the FY1. If it's middle, you give it a 2, and if it's low, you give it a 1. Couldn't capture it this way.
Then I'm giving it a positive score for being in the loser category. Actually, I want to have a negative score.
Yeah, but for example, if
I did that
firm
consistently
1
with everything,
was in the middle for ROE, then you could give it a -2, not a -3, but a -2.
A lot of this depends upon the information that you're getting from these sorts. Okay, and I'm kind of assuming for FY1 that I've got the ability to put together a portfolio that does really well with respect to my benchmark. Okay, so I can find the outperformers with this, but I can't use that measure to identify losers.
But one of your criteria for saying how good your screening is to say that it's consistent across the fractals, so you should be able to do that.
Yes, but it might be that it's consistent, but it's just not dramatic. You know what I mean? That you see a deep, so number 1 looks really good. The middle is much lower, so it's consistent. but it could be around benchmark. And the lower maybe is lower also, a little below benchmark, but not nearly like ROE, which is like a minus 20% below benchmark. Okay, so I'm just going to use the information. But what you're suggesting is feasible to do. Again, it's a matter of you are designing the strategy. Okay, so if you actually want to, you see consistent performance and you're going to grade 3, 2, 1, and you do that consistently for your factors, that's fine. Okay, it just means that we're going to have a different sum. We're going to have a different scoring screen. And you can run that against my screen and see what happens. And we don't know what's going to happen. So it's a reasonable suggestion, but kind of the way that I was thinking of constructing it is my example, so I'm biased. The way that I constructed the example, that these 4 things stood out for only one portfolio within the screen. Okay. So is that reasonably clear how to do this scoring? Okay, let me just mention a few other things that are going to be important. Turnover. Turnover can create a lot of transactions costs, obviously. And some factors will induce a lot of turnover. And other factors, not as much. So you could be in a situation where you're looking and trying to get your final 4 factors. And you're looking at, let's say, price to book is a candidate, and it's kind of tied with some sort of momentum strategy. Let's say it's like a 1-month momentum. It's kind of tied. It looks about the same, but it's tied. Well, the 1-month momentum strategy is going to induce just massive turnover. And you can actually calculate the turnover by, the number of kind of like the proportion of new firms each month in your screen. So you can actually do a calculation like that. And that's information that I look at also. So we could add that to the list. So I'm biased towards factors that don't induce massive turnover. Okay? And momentum is one of those factors. A couple other things that are going to be important. The first one is that we have to make sure that we're neutral. Okay, so we need to check those betas and make adjustments if we're out of line. Number 3, I think I've already told you that we would have a knockout criteria. And this is basically knocking firms out of the buy list, doing various searches, for jail, stuff like that, fraud, the usual stuff. Okay. Number 4, the financial analyst. Mentioned last time, let them take a look at the list. Let them give them some leeway to make adjustments. And number 5 is related to turnover. Look at the scoring screen over different horizons. So look at it over 1 month, hold, maybe a 6-month hold, and a 12-month hold. So January 31st, I put my scoring screen together. Okay, do all the scoring, sort, figure out what the buy portfolio, figure out what the sell portfolio is, and hold it for 12 months. No transactions costs other than initially getting in and what you have to do to get out. So these are all kind of implementation issues. Okay, so let's. I'm gonna get the time right today. Let's take 15 minutes, and then when we come back, what I want to do is to do the alternative weighting, the optimal weighting, and I want to show you results. Okay.
So then we're thinking of like having a cumulative effect. So adding if you have the weld, or 0, if you do use the weld and you set it to 1, then you say, okay, depending on what the cumulative total is up to this point, then
this thing only applies to years 35.
yeah, so you have to set up.
Okay, let's get started. Okay, so I want to go through, first I want to talk about the optimal kind of scoring, and then I want to show you some results. Some old results, some new results. Some you have, some you don't have. Okay? There were 2 things that were mentioned to me at the break that are relevant. Number 1 was, how do we assess market neutrality? And I guess the short answer there is that you know the stocks in your buy portfolio after your scoring screen. You know the stocks in your sell portfolio. Presumably, you can figure out some measure of beta for each of those, and then you just weight them together to get the portfolio beta. So remember, the beta of the portfolio is simply the weighted average of the betas of the individual securities. So beta is linear. Okay, so you can make some adjustments. The second thing is this issue of value weighting versus equal weighting. We talked about that a little bit. That can make a big difference. I tend to prefer value-weighted portfolios because equal-weighted really is kind of like some sort of size strategy, so capitalization strategy. And then there's one final thing that I wanted to mention. In doing this whole exercise, we haven't really talked about tracking error. And in the long-short strategy, what's the benchmark? Any idea? The market? 0. Big difference. If it was a long-only strategy, then the benchmark is the market. Okay. Once you go long-short, then supposedly you're taking the market out. If you take the market out, then the expected return to a 0 beta strategy is.
Should it be a T-bill? Should it be a T-bill?
Yeah, just like a short-term deposit. Okay. So in the long-short, it's like a treasury bill type of expected return. However, and this is really important, this really assumes that the only risk that's relevant is the market. Because you're going to notice that your long-short portfolio, it's got greater return than the treasury bill. It's got 0 beta against the market, but it's got substantial volatility. So you could have volatility like the market volatility. So I'm always a little hesitant to say, well, the benchmark for this is the T-bill rate, because that really assumes that the only relevant risk is the market. Okay, so if I do a long-short sort of strategy and I see that the return to it is, you know, in single digits, I'm not sure I'm that impressed. Okay. The other issue is if you're just long and your benchmark is the market. We've done nothing to control for tracking error. Okay, we're doing this unconstrained. We're figuring out, according to our scoring system, what the best portfolio is, what the best list of names. There's no tracking error optimization going on. It is possible to kind of modify what you're doing. Given that you've got a list of names that are qualifying for the buy portfolio, it is possible to go and do some sort of tracking error minimization based upon those names, which would lead to a weighting of those individual securities that might be different than value weights or equal weights. So it is possible to layer the tracking error sort of methodology into this. You need heavy-duty optimizer to do this, because you're operating off individual securities. So not Excel solver or the next generation solver. It's something like Northfield, where it's their business is optimization. Okay, so it is feasible to do that. Okay, just as I'm about to write on the overhead. Okay, so those are important things to keep in mind. Now let's talk about kind of the optimal weighting of the attributes. You're not going to be able to see this, but the webcast students, no problem. Actually, maybe I can figure out how to put the screen down. Light screen. Okay. So we've done this scoring of these 4 attributes. There's one thing that's really important that this scoring doesn't take into consideration. Actually, there's 2 things that are important that it doesn't take into consideration. Any ideas? How did we establish the 3, the 1, the 2, and the -3? What did we look at?
The returns.
Okay. And we just looked at the returns. Now, if you're putting a portfolio together, which is what we're doing, and I just gave you the returns of the individual assets, would you say that's enough information? No. And what else do we need? The variance. So we need the volatility. Is that easy to get? We've got, remember, we've got 4 screens here. We've got change in, what was it, expected earnings growth? FY1. So we've got the return for it. It's easy to get the volatility, right? We've got monthly returns on that strategy. It's a matter of figuring out what the standard deviation is. Okay, anything else? Is that enough? Doing optimal portfolio selection. We got the means, we got the variances.
The covariance.
Covariances, of course. We need to know how these things interact. Okay, so really what you can think of is, in a crude way, we've got the performance we've got some volatility. And we've got our one here at 20%. We've got something at 10%. We've got something at 5%. And we got something at minus 20, which maybe, I'm just guessing, is here. So this portfolio is just the change in FY1. It's a portfolio. It's got a return. It's got a standard deviation. And I'm just graphing it. And I do the other ones. OK, so how are we going to put these things together? It's kind of obvious, right? We've got 4 portfolios, just like the portfolios that you're working with in assignment number 2, right? Just portfolio returns. It just so happens one of them is like really bad. You never had to work with anything in assignment number 2 with a minus 20% average return. But it doesn't matter. So what are we going to do? Over some period, perhaps up to our holdout sample. So maybe we're holding out 1998, 99, 2000. So at the end of 1997, we optimize and calculate the efficient frontier. So let's do that. And when we do that, I'm going to hypothesize that the curve looks like something like that. Okay. Got it? Now, to get this curve, I need to make assumptions on short selling. And I'm actually going to allow that. So I'm going to constrain my weights to go from, let's say, minus 100% to plus 100%. Okay. And the reason that I'm allowing for short selling, what's the reason?
So you can short sell.
Yeah, it's a bad portfolio here, right? Like I want to get some negative scores on the stocks in that portfolio. Now, it's somewhat arbitrary, what I've done here in assigning these short weights. Like I just said, let's do 100, but it might be 50 to 50. It's a different choice, going to lead to a different strategy. So again, this is quantitative, but there's some art involved, some experimentation. OK, so then what do we do with this? So we've optimized the data from 87 to 97. We get an efficient frontier with the short sales. So what do we do after that? What does it mean? How do we proceed? How do we implement, given that we've done that? Ideas? Just 4 portfolios. Got average returns, standard deviations. I can calculate the correlations of these portfolios. Stick it into the optimizer, figure out the combinations that deliver the highest expected return, the lowest volatility. So now what do I do? How do you actually implement this? I've done this. It's December 31st, 1997. The output delivers a frontier, right? So, yes?
Can you use the weights to do another round of scoring?
OK, it's a good idea. That is correct. But what weights?
The weights on these portfolios. So if one stock is in the...
Let's just think of the portfolios right now. So Where do I get the weights?
The optimizer.
Didn't you get that?
The optimizer delivers weights, that's true, to draw the frontier, right? You see where I'm going? The frontier is just, each point on the frontier is characterized by a set of 4 weights. So I've got like an infinite set of weights. Which ones do I pick? So where do I go here? Yes?
Where do we look at the standard deviation of our benchmark?
The standard deviation of the benchmark. Okay, so basically the idea here is that we need to make a choice as to where to set the standard deviation or where to set the target return in order to get a unique set of weights, right? So one possibility is the standard deviation of the benchmark. Yes?
Is there an optimal tangency portfolio here? You could maximize for a given standard deviation maximum. Just like we did, starting from RF, you draw
Yes.
a tangency portfolio and you say, okay, that has the maximum.
So it's another possibility. If you want to assume RF is got 0 volatility, you could pick off the tangency portfolio. Okay, that's going to deliver a unique set of weights. Okay? The answer is we need a unique set of weights, but it's not clear which ones you should use. So it might be you just want to set the volatility to something and pick off a set of weights. Okay, so let's say that we actually follow the suggestion of the benchmark volatility. And suppose the benchmark volatility is right here. We've got a portfolio here that's got a set of weights. So we've got W1, W2, W3, W4 for our 4 assets. W4 is the weight associated with ROE. What is the sign going to be? It's going to be negative, almost surely. So what do we do with this in terms of how would we turn this, given that we've got 4 unique weights now, into our final scoring screen portfolio? So how do we set the portfolio up for January 1998? How do we translate these weights into actual portfolio? Ideas? It's actually easier than it seems. Yes?
When you basically, if you got like a weight of 0.4 for weight 1, to take 4/10 of this portfolio would be the portfolio of those attributes that from attribute 1.
Mm-hmm.
And then accordingly for attribute 2 and 4 with the respective weights. I don't think that was very clear, but
Yeah, I think what you're saying is you just you could think of buying and selling what the weights tell you to do, right? Now, it could be the situation, of course, that you've got stocks that are being double counted, right? So suppose the weights are, let's say this one is minus 0.5. This one is 9.9. This one is 0.5. This one is 0.1. Does that add up? Yes. So you could just basically implement these portfolios, right? Another way of doing this is consider what we've got here. Just call these the new scores. 0.9, 0.1, 0.5, and minus 0.5. Okay. Go back to our spreadsheet. instead of assigning 3, 2, 1, and minus 3, we're assigning 0.9, 0.1, 0.5, and minus 0.5. Okay, so the weight, you could think of what the weights are doing in the optimization is giving us the simplest way, I think, of implementing this. The weights in the optimization are delivering a new set of scores. Take those scores, do the same thing here, sum them up, and look at the, again, look at the buy portfolio. Okay, sum them up, sort. And you get the buy and the sell. Okay, so is that clear? So we're taking these weights and then using them as a new score, and then we're going to sort the score to form our portfolios. Yes?
Okay, so just so that way I'm clear on this. The reason why we're using these new scores based on the optimizer is because the new scores take into account the covariance of the different portfolios.
And the volatilities.
The volatilities. Whereas those, so we're just replacing them. We could have stuck with these scores all we wanted, but
Correct.
since they didn't take into account the covariance, then it's an inferior way of putting it together.
That's what we think.
Okay.
Okay, because we're just taking the average return into account. You know, there's other stuff we're taking into account, right? And actually setting the 3-2-1, it might not be 3-2-1. I listed a number of things, like including consistency and stuff like that. So we're taking a lot into account. We're actually doing that to get them there. But once they're here, there is an alternative, and that's to use the optimization, which takes the correlation of these things in together. Okay, let me just give you the rough idea here. It might be that we end up with, let's say, 7 things that do a really good job, okay? But 4 of those factors are really highly correlated. Okay, so really it's one thing that's driving 4 factors. Now if we go in and do our scoring like this, we could be like grossly overweighting one thing, one particular style of attribute. Even though we've got 4 different factors, they're all being driven by one thing. Okay? When we optimize, it's going to take care of that. Because if they're correlated, then they're going to be, as a whole, they're not going to get equal weights. Everybody see that point? So it could be that you've got like 4 attributes that are basically delivering the same portfolio. Okay, because they're proxying for kind of like the same thing. And if we just score like this without taking correlation into account, then we run the risk of overweighting something. Yes?
I have a question with regards to the efficient frontier.
Yes.
In the earlier sessions, you sort of talked about the average efficient frontier and the unconditional mean variance frontier being such that we can't really outperform it unless we use a predictive type model. In this case, what is our likelihood of reaching the frontier?
Well, actually, we're not even going to try to reach the way that I've suggested using this. You take these weights, right, and they're simply used as a scoring mechanism. Right? We're not implementing each weight in our portfolio. All we're saying are here are the weights that end up in our final score, sort, and buy the securities in the high and sell the securities in the low. Okay, so we're not even trying to hit the frontier, okay, in doing that. And your question is, well, you know, we talked about this is an ex post frontier, and we're using an ex ante way. Really, all we're doing here, you can roughly think about this as we're using kind of the historical correlations to try to get a better sense of how these things move together. We're hoping that the historical correlations actually come through in the future. And fundamentally, we are hoping that the past performance of these screening attributes are representative of the future. In this case in particular, we've got, you can think of what we're doing. One of these attributes is change in FY1. Just think about it. We can get a 20% spread on that particular variable. Right? We're only going to use that in an out-of-sample strategy if we think that we can get 20% in the future. Right? So in a way, it's like a forecast. Okay, so in this particular case, we got not individual assets that are going into the optimizers, but strategies. We have strategies going in. And those strategies are designed to be consistent. Remember, that was one of the things that I wanted, consistency. So if I've got consistency, then I've got some idea that the past is going to be, repeated in the future. That's the whole idea. So it's not quite what we did before, where we just dumped in some asset returns and optimized. Right? What we're doing now is we've got basically trading strategies, 4 trading strategies, 3 winners and 1 loser. And what I want to do in the optimizer is to determine the optimal combination of these strategies to deliver the highest expected return. There's other technologies that do similar things, like genetic algorithms. It's kind of the idea that you give it a number of strategies and then it's dynamically selecting the best one. This is not the only way to do this. Indeed, a GA is pretty well suited for a task like this. Okay, where you've already got your strategies, you know the winners, you know the losing strategies. You just need to put them together in a way that's the best possible way. So everybody see that we're feeding the optimizer strategies? Okay, and the strategy is already conditioned on a particular variable. And the idea of the strategy is for it to produce a return in the future that looks like what it's done in the past. Rather than just dumping an asset in where you have just no idea whether the past, indeed, you just put an asset in, you have no idea if the past performance is going to be representative of the future. Okay? So is that reasonably clear? Okay, so I do that, I sort, I get a buy portfolio, I get a sell portfolio. I implemented that December 31st, 1997. Hold it for January. January 31st arrives, what do I do? What do I do? Resort. Okay, that's true. So I get a resort on all 4 attributes. And then what do I do? How do I score? Do I use the old scores? Not necessarily. Stuff happens, right? So what do? If we want to use the optimizer, re-optimize. Again, you could think of an expanding window for the optimization. You could think of a rolling window where you drop the oldest month, you pick up a new month, re-optimize, rescore, and reallocate. Yes?
When we're optimizing, what period are we using to optimize? Do we just pick an arbitrary point in the beginning? Do we ever want to wait the most recent month, like for example?
Well, let's say in my example, we're optimizing December 31st, 1997, based upon at least 5 years of data. Okay, and then we might want to step that forward 5-year rolling window, and that's indeed the way that I implemented some of this stuff when I did this work for Merrill Lynch Global Asset Management, where we had a rolling optimizer that delivered weights every month on many different markets. Okay, so that's this screening seems simple enough. We could run a screen, but to put it together is very difficult. Okay, and people always talk that traditional asset management, there's an art to it, whereas that's all kind of replaced by these quantitative models. That just shows you don't understand much about quantitative modeling. Okay? Because the actual model building There's a lot of judgment that actually goes into it. And even the output, you've got to use judgment. Effectively, as I said at the beginning, we have kind of like created an incredibly complex, nonlinear kind of regression in going through all of these steps. We've got something with a lot of flex. Remember I said on Monday that what we're doing gives us flexibility? And it does. We've got a lot of flexibility. We can look at an attribute and score it high if it's consistent, even though there might be something else that's got a higher average return that is not consistent, that the regression, a simple regression, would score very high. We can look at more information than a regression. We can put more sort of utility assumptions in the actual process. Okay, well let's take a look at some performance. And unless there's any other issues on the actual implementation. Okay, I wanted to show you, last time we looked at the Malaysian dividend yield.
Question back there.
Oh, question? Sorry.
If you use the weights that you got from the optimizer,
Yes.
then in terms of discretion and judgment versus those weights, haven't you kind of overridden that to an extent because you are incorporating some of the, maybe there's skewness or consistency in it versus your own scoring system?
Right. That's true. Okay, so, but what we do pick up is this correlation factor. Okay, and indeed, you might want to think of a mixture. Right. So you go through, you take a look, and we've used a lot of judgment just to isolate those 4 factors. Right. There's what, 54 total. So we knocked out 50. They're gone. Right? And we haven't used a regression to do that. So we've used a lot of judgment to get it down to those 4. And then we're just not sure how to put them together. If we just use this, based on just the pure returns, then that's probably not optimal, right? But if we look at their performance, consistency, and all that, come up with some sort of scoring, right? And then we run the optimization and take a look at the difference, then often, and what I've actually found in implementing this, you see basically what I said, that there's like 3 things that are basically delivering the same information. Okay? The optimizer is saying, don't, give this thing triple the weight that it should. Maybe it should be 1.5. Okay? And then you can use some judgment to actually change your scores. Okay? So is it the case that you always implement the optimizer in terms of its weights? No. There's a lot of stuff that's arbitrary in actually dealing with the optimizer. I try to be honest with it. The volatility that you're choosing, why not choose the minimum variance? Indeed, actually, that's one of the ones that we looked at. The minimum variance portfolio, and just figure out the weights on that. That seemed like an agnostic one, rather than arbitrarily setting the variance or setting the variance equal to the market variance, whatever that is, right? So want to look at the minimum variance, pick off the weights there, and use that. Well, what about the short and the long restrictions? I said 100 minus 100. What about 50 minus 50? There's a lot of stuff there, right? And indeed, if you've got the resources to do it, you could test these different strategies historically. Is the minimum variance strategy the optimal strategy? Or is it one where you set a higher volatility? Or is it the tangency portfolio that delivers a better score? It's a matter of actually doing this. And I've said this is not written anywhere. There's no manual to open to say this is how you do stock selection. So it's a lot of trial and error. And hopefully you've got some time to do the trial and error, because if you start running real time, you don't like many errors. Okay, yes?
You were mentioning about the choosing the long and short positions. In the way you choose them, is there any reflection on the risk that you are willing to take? Do you have to consider that, or how would you choose them?
Well, the long and short are just 2 different portfolios,
no,
right?
I'm saying the plus 100, minus 100, or plus
Oh, I see what you're saying. I'm afraid I actually did not really investigate minus 100 to plus 100, and whether that performed better than minus 50 to plus 50.
But
I
is
actually
there,
didn't
like,
do it,
sort
but
of a reason behind them, like anything that.
just kind of judgment. I wanted some negative weights, and like indeed, you could do this with the sum of the weights not even equaling 1 if you wanted to. Sum of the weights could equal 0, and then put no restrictions on. It's a matter of testing, because there's no theory for this. Like in a way, it's good. There's no theory. It's what you want, in a way. There's no book on this. That's good. There's no articles really on this. The stuff that I published, there's no mention of how to put all these attributes together. There's no real mention of how the scores were actually assigned. So it's like, why don't? Yes.
Once you develop your buy portfolio and your sell portfolio, do you have to go through your sell portfolio and see that each of your expected returns for each security is negative, or is that's not
Doesn't
an issue?
matter, because if you implement the long short, as long as the long has a higher return than the short, then you're going to make some money. So the sell portfolio might outperform the benchmark. Okay, and as long as the buy portfolio outperforms the benchmark even more, then you're going to make some money with a zero, market risk. Hopefully, zero market risk.
So that's assuming that some securities in your short portfolio will have positive gains, but they'll be small positive gains, which will
Small relative to the long portfolio. All you care about is the spread. It is, in terms of the original kind of like terminology for hedge funds, this is what they're supposed to do. Right? A long short, that's a hedge. Taking a bet on Malaysian currency, that's not a hedge. It's a bet.
Question.
Yes.
I'm curious as to your opinion about how applicable this is to the individual, the non-institutional investor, from a technical perspective. Is it realistic to implement a model similar to this?
Well, why don't you just wait until I show you some results? Okay. I was up. Unfortunately, I got logged off my FactSet connection, but I was doing a sort that looked just incredibly powerful of, what was it? It was a value sort and a bivariate with change in FY1. And it delivers the buy list and the sell list. It's not as complex as this, but I'm going to show you some simple screens that do just amazingly well. Do you have the ability to go in and buy 1,000 securities and sell 1,000 securities? Well, it's a little bulky right now, but with electronic sort of trading, it's becoming easier and easier to do. Indeed, I see hedge funds out there that are starting out with buy-sell strategies that are managing less than $1 million. They have a small universe of securities, like the S&P 100. And that's not a large portfolio. Maybe it's not what you have right now, but this is quite applicable. The problem is getting the FactSet connection, which is very expensive, because you can't reasonably think about doing this in Excel. Okay. Not if you're looking at the U.S. market. Okay, let's look at a few of these results. I showed you Malaysia dividend yield, and that was like really stunning, 25% in terms of performance. I just wanted to show you that that's not the only attribute in Malaysia that looks pretty impressive. This is change in FY1, and you'll notice in these screens that these expectational data are really good data. Okay, and most of the stuff, if you see anything published on stock selection, other than my papers, they simply use past accounting data. They don't use expectational data. This is in Malaysia Exhibit 5H. And here you can see, take a look at the value-weighted portfolio. Let me zoom a little more for the webcast students. Okay, the value-weighted portfolio, check the returns here. The buy portfolio is in a 1% return. That doesn't look too good. A 1% return. But the benchmark over the period is minus 7%. So it looks very good. And the sell portfolio is minus 10. So it's worse than the benchmark. The spread on this is 11% between the high and the low, which is pretty impressive. Equally weighted spread is about the same. So an equally weighted portfolio, the winner portfolio is a minus 3% return compared to a minus 7 in terms of the benchmark. And again, if we want to look at consistency, if we go down a little bit, the buy portfolio is consistently more than 54% at least outperforming the benchmark. And the year by years look pretty good too. Now, if we skip to the next one, which is last 6 months, the change over the last 6 months, you see something similar in terms of performance. So here we've got a 3% return and a minus 12%. So here the spread is 15% per year. Would you want to put both of these in your final screen? So both these factors look real good. But you know, even without doing your correlation, that they're very much related. So one is a 3-month change in FY1, and the other is a 6-month change. So in this case, I just choose one. And in this case, I choose the 6-month change. Okay, so there you're actually using the correlation to actually, to do the weighting before you actually get to the optimization. If you put it in the optimization, it's basically going to be down-weighted anyways. One thing to notice here is look at the following. The relative rank in terms of performance each year. Okay, so 3 is the best, 1 is the worst in terms of performance. And this is the winner portfolio, or the high portfolio. This is the low portfolio. So notice there's a lot of 3s here, which is very good. Okay? So it's almost all 3, which means it's the best performer of the 3 portfolios. However, notice there's a 1 right there. So let's investigate that a little bit. So that is in 1997. In 1997 is right here. We're at 28.06. Remember, all of these are benchmarked to 100 at the beginning of the year. So that 28.06 means that the 100 turned into 28.06. This is the Asian crisis, right? Now, notice that the portfolio, which was, we thought the loser portfolio, it performed the best. So you got a rank switch there, which is something I said we need to worry about. But in this particular case, I'm not that concerned about it, because there's only a very small difference between 28 and 30. So it's less than 200 basis points. The 28 is trivially different from the benchmark, which is 28.34. So I don't actually put a lot of weight on this switch here from a 3 to a 1. Okay. Notice the out-of-sample period that we're using is a period where there's substantial crisis situation. And also notice that for this particular attribute, it seemed to work pretty well, even in the out-of-sample situation. Let me go to the scoring screens for Malaysia. Okay, so this is after we assign the optimal scores. And this is evaluated over the whole sample, not just the out-of-sample period. So it's a little biased. Yes?
Do you do anything with your portfolios and keep yourself from getting wiped out in those years like 1997?
Say it again?
Is there anything that you can do with your portfolio to keep from getting wiped out?
Well, we're not wiped out. We actually make money, right? Because you're long and short. So the short, makes a huge amount of money. The long, it loses money. But in '98, there's a small loss, but you get it back very quickly. You actually get it back in the first couple of months of '97. You lose a lot of money. First couple of months of '98, you get it all back. Okay, so this is the monthly scoring model. And again, take a look at the spread in the returns here. Is basically the buy portfolio's got a 10%, 10.59% return. The sell portfolio has got a minus 19% return. The market benchmark, yeah.
Exhibit you want?
Say it again?
What exhibit?
Oh, sorry, Exhibit 10A, monthly scoring for Malaysia. Okay, got it? Exhibit 10A. The spread here is quite significant, obviously. It's 30%. Okay, and a market neutral strategy. Note, if we take a look at the betas here, the beta of the buy portfolio is 0.93. The beta of the sell portfolio is 1.01. So the sell portfolio has got a higher beta than the buy portfolio. So actually, if we did a simple spread portfolio, it's got like negative market exposure. We could adjust for this, but they're pretty close, those betas. If you look at the alpha difference, it's even greater. So the alpha difference pushes it to about 32% spread. Again, you can look at consistency in terms of the ability to win. And take a look at this column right here. 5 means the portfolio that does the best. And there's a lot of 5s there. Notice there's a 1 in the very first year. And I guess that doesn't bother me too much, because there's a smaller number of securities back then that were tracked by IBIS. And I don't really care that much. Notice that portfolio number 2 had the 5. Okay, and the actual performance in that year wasn't that different than the benchmark. So 139 versus 144. Okay, so that's the monthly scoring model. We can also take a look at a quarterly hold. So this is not using the information every month, but using it only every quarter. Do a similar exercise, and again you see the spread is less. The spread is now 6% performance for number 1 portfolio and minus 16. So it's a 22% spread, but we know that there's substantially less transactions costs if we're rebalancing only quarterly. And the final scoring model is semi-annual. Again, the spread is less than the monthly because we're rebalancing only twice a year, but still it's pretty impressive. Minus 18 for the sell portfolio and 4 for the buy portfolio. And pretty consistent winning performance throughout. Yes?
A little bit further down, you can see your portfolio 2 actually has done better than your portfolio 1. If you go to relative performance, does that concern you now?
You mean down?
In relative performance?
Relative performance. So I see a lot of, it's 5, 4, 4, 4, 5.
Yeah, I'm looking at average relative performance of the...
Oh, the average relative performance. Yeah, that's an issue. But actually, I kind of prefer, these are quintiles, right? What would you do if you saw something like that? How would you handle it? I've seen this many times. So we sort it into quintiles, and we see that 1 and 2 look pretty good. So what do you do?
Combine both. Make them
Well, you could combine, so that's one possibility. So in your sort, you could change the sort. Instead of quintiles, you could go quartiles. Okay, and then maybe it's clean. What else could you do?
Just use portfolio 2.
You could score portfolio 2 also. Now be careful here. I don't want to see people scoring portfolio 2 and not 1. Okay, because that's like using the 7th lag of the change in the oil price. Okay, consistency is important. If 1 and 2 look good, fine. And then I hope to see, as we do here, that the performance degrades. And it does, right? It goes down to 2, down to 1. But it's not a clean separation here. Even like 3 and 4 are a little inconsistent.
The beta on 1 is also lower than 2.
That's true, but not significantly so, right?
Well, it helps explain, I think.
Yeah.
I mean, isn't the big point that they're both a lot better than the
Right.
fifth quartile?
Right. I think that is the point. So remember, we're using 20% cutoffs for the fractals. You don't need to do that. You could use the first one could be the top 30, then it could go by tens, and then you could choose the bottom 30. It's up to you. Again, that's another choice that you have to make as a person doing quantitative selection. What is the fractal cutoff? Indeed, in a lot of this, early on in the data, you would actually prefer a smaller number of fractals because you have fewer firms. Okay. There's another thing here where I look at a knockout criteria where we pull some firms out that that we know in advance have got problems. And this is semi-annual again with knockout. It really helps the buy portfolio, where now the return is 7.28. Sell portfolio is minus 11.13. And you've got a spread now, 18, 19%. Okay, so that's using some knockout criteria. That's Malaysia. There's Mexico, South Africa. There's lots of stuff. I wanted to show you some detailed output from a couple of markets, and let me do that right now. So this is a bivariate sort now, not a univariate sort. And I'm gonna not talk about Mexico or South Africa. I want to talk about what I've done here for Malaysia, maybe South Africa bivariate a little bit. It's going to be hard to see. This, I'm not sure you actually have this. I might have stuck it at the back of the Malaysia handout. This is a bivariate sort of market capitalization and price to book across the top. So quintiles in price to book and tritiles in capitalization for Malaysia. Okay, and this is what the raw output looks like from FactSet. Okay, this is part of the raw output. And it's a special package that they've got called Alpha Builder. Now notice that, notice the following. Look at the price to book performance for the large cap, which is for the top portfolio is 0.07, the bottom portfolio minus 0.42. Now look at the price to book in the small cap. Small cap is 1.41, and the loser portfolio is minus 1.62. Do you see what's going on here? That the spread, if we implemented this strategy of price to book, screen, long, short, just on one attribute, if we implemented that on large cap, we get maybe 0.5% per month, so 6% per annum. If we implement this on smaller capitalization stock, the spread we get is 3% per month, 36% per year. Okay, so this is the power of a simple bivariate screen. Okay, so you talk about how could I implement this? Well, this run takes maybe 10 minutes to do. And you get the list of securities. And I might be interested in the securities in cell 1-1 and in cell 1-5. Okay? It is a small cap strategy, but it would be a hedge strategy. And this is substantial performance. Notice the benchmark return over this period is minus 0.22. Even if we just bought securities, okay, had no shorting going on, 1.41 is hugely above minus 0.22. So this is an example of a bivariate screen. And let me show you another one. Also did the same thing, value weighted, and it looked very similar. So no big difference, value weighted or equally weighted. Okay, this is interesting. This is run through January 2001. Okay, so the most recent data. So suppose I actually implemented that using the most recent data. And this is price to book and market cap. Okay, it's a little different in that we're now reading down rather than across. So the rows are switched with the columns. Apologize for that, but that's just the way the output came out. So we're comparing cell 1-1 with cell 5-1 now. Okay. Consistent performance. 3% per year. Or 3% per month. 36% per year. So again, we see a price to book effect with the small cap stocks that is dramatic. For the large cap stocks, you also see a price to book, but it's not as dramatic. So it's consistent across all size, but it's not as dramatic. So how would I implement this? So I noticed that for small cap, there's a huge price to book effect. But for large cap, yeah, it's there, but it's not huge. So how would you do this in terms of your scoring? Basically, what you're going to have is a differential score, depending upon your capitalization. So if you're in the small cap group, then price to book is going to get a big weight. If you're in the large cap group, it's going to get a positive weight, but it's not going to be nearly as big. Now, just to show you two other markets, this is South Africa, and this is the, basically it's a sort of the prospective earnings growth with the IBIS revision ratio. And again, you can see this is a bivariate sort that the benchmark return here is 2.94. Our 1-3 portfolio delivers 6% per month on average. So again, 3% over the benchmark for this one portfolio. Okay? Here we don't see any big losers, but that 6% is very substantial. Okay, enough of the emerging markets. I don't have much to show you for the US, but I did do one of them. They take a little longer to run because there's 5,000 securities. And this is just a simple sort. Okay, it's a simple univariate sort, and I'm sorting on the IBIS 3-month change in FY1. Okay? And of course, the US market you would hope would be the quickest to incorporate information. But we got 5,000 securities. We're, as soon as those IBIS numbers come in, it's put into our database. We form the portfolio just like I suggested. We work in quintiles. And these are the returns to the strategies. So the benchmark return over the period from 87 to 2001 is 1.05%. Fractile 1, 2.1%. So this exactly doubles the return on the market. a long strategy in the securities that had the best revision in FY1. The lowest portfolio, number 5, is 0.77, which is below the market, so it would qualify in a pure short situation, but it's not dramatic. It's not negative. But our long-short strategy here, which can be implemented reasonably easily, delivers 16% annualized return. Okay, this is the US. This is not Malaysia or Mexico or some emerging market where you know the transactions costs are massive. Okay, and you might have to hold for a year or 6 months. This is the US, and this is one factor in the US. One factor. Like I showed you factors for these countries, right, one by one. And we saw when we put them together in a scoring screen that we could do better than the one by one. Okay, so you know, I want you to see this because basically the message here is there is a lot that can be gained by doing the individual stock selection. Now, maybe you would discount, that we saw 25% spread for a dividend yield in Malaysia where you've got all sorts of problems like currency convertibility, right? But in the US, through the most recent data, one factor can deliver 16%. Okay, now here again, I'm not sure the benchmark is the T-bill rate because it's got volatility, the strategy. But it suggests to me that in implementing these long-short strategies, it's not that difficult to do. Yes?
How much do you think in terms of percentage with transaction costs knock out of that?
Just to knock it down a bit, but you know how it is easy to transact now. The transactions costs running this in 1987 are going to be a lot larger than they are today. But this provides consistent performance. There's information in these factors, a lot of these expectational factors, that can be used on a large scale. So it's not like we're picking one security or 20 securities. I'm operating with 5,000 securities. Picking the ones that had the largest revisions in FY1, implement the strategy. One factor, 16%. That to me is quite exciting. It suggests to me that we've been struggling with prediction models for asset classes, 5% R squared, 4% R squared, and trying to eke out some extra performance. There's a lot to be gained here in terms of performance in the asset selection. So go beyond the asset allocation to select these individual assets. Okay, so that's basically where we are in stock selection. On Monday, I want to talk about high-frequency strategies. Okay, so I will talk about some of the stuff that I've implemented, basically day trading. Okay, this is monthly, quarterly, semi-annual. Well, what about within the day? Okay.